Welcome to PIMCO Pod. In this episode, we discuss the outlook for U.S. housing prices. Stay tuned after the conclusion of the podcast for additional important information. U.S. housing inflation, stubbornly high to stubbornly low, by Tiffany Wilding and Munish Gupta. Housing inflation has remained stubbornly higher than market expectations since rental inflation spiked in 2022. Looking ahead, we believe not only that housing inflation is behind us, but also that rental inflation will run much below the pre-COVID norm. Recent history. After a housing supply glut contributed to the global financial crisis, GFC, in 2008, the U.S. housing market only slowly normalized from 2012 through 2019. New housing unit construction remained below the pace of household formations, which helped reduce overcapacity, and both home price appreciation, HPA, and rental inflation, owner's equivalent rent, OER, advanced at a slow and steady pace. However, from 2020 to 2021, pandemic housing demand surged due to extraordinarily low interest rates, a shift in consumer preference for owning a home, large fiscal transfers, and strong economic growth. The post-GFC decade of underbuilding coupled with the surge in demand drove home price appreciation to about 20% annually on average in major metro areas, a pace not seen even during the pre-GFC housing boom. Home price data from S&P Totality Case-Shiller indices. The dynamics of rental inflation. As home prices rose at this unprecedented pace during the pandemic, similar-sized rental inflation was just a matter of time. Residential unit prices are closely linked to rents because 1. Investors in rental properties demand a certain yield on their investments, and 2. As housing prices rise relative to incomes, buying a home becomes less affordable, driving rental demand higher. With some lag, about 12 months, the new lease rents increased in line with housing prices, according to U.S. Consumer Price Index, CPI data. However, rents do not rise uniformly. About 20% of renters move each year, per the U.S. Census Bureau. A spike in new lease rents, therefore, quickly and completely affects about 20% of the renter population, while the remaining 80% who renew their leases tend to see increases much more gradually. Landlords typically prefer to keep existing tenants because of the upfront costs associated with new tenants and loss of rent during vacancy. Hence, the net change in rent occurs slowly. It takes about 4 additional years for renewals to catch up to new tenant rental rates. Data suggests the time needed for lease renewal rates to catch up to new tenant rents was the main reason why OER was stubbornly higher for longer. Another contribution was the significant influx of humanitarian immigration into the U.S. from 2022 through 2024. Most of these new households were limited to the rental market due to credit availability. Where are U.S. housing prices now? The pendulum has swung the other way. Housing affordability had declined as interest rates rose in response to inflation and due to strong home price appreciation relative to wage growth seen during the pandemic. Now, although U.S. GDP growth remains fairly strong, real wage inflation has cooled, and wage levels have not fully adjusted to the now much higher costs of purchasing and maintaining a home. Trump administration immigration policies have slowed new household formations, and a normalization in remote work has reduced the urgency to trade up for space. Finally, a surge in new multifamily building in the wake of the pandemic is now delivering fresh supply into the tepid demand market. New supply has especially weighed on rents in Sunbelt cities. Over the past 12 months, this confluence of factors has led to flat home price appreciation. In real, inflation-adjusted terms, HPA is actually negative, a positive development because it should improve affordability over time. At the same time, rental inflation is decelerating fast. Zillow's new lease data show rents rising at a rate of 2.1% annually, which is almost 50% lower than the pre-COVID norm. Single-family rental inflation, as measured by Totality, is even lower, growing below 1% annually for the first time since the GFC. The gap between new lease rental rates and renewal rental rates has also largely normalized, alleviating another persistent source of inflation within the rental market. The outlook for rental inflation doesn't look much different. Although the pace of new housing supply is already slowed, data also show rental homes are sitting on the market longer, which may put pressure on landlords to further discount rents for both new and renewal leases in the months ahead. Bottom line, the rate of U.S. rental inflation is likely to turn a corner this year, going from stubbornly elevated to surprisingly low, even dipping 30% to 50% lower than pre-COVID norms. With rental inflation, rents, and OER making up just over 30% of the core CPI index, a 1 percentage point deceleration would reduce core CPI inflation by 0.3 percentage points. This, along with fading cost pressures associated with tariffs, plus higher productivity, reducing the labor costs of output, should give the Federal Reserve comfort that inflation is heading sustainably back to its 2% longer-term target. In recent years, OER proved stubbornly high. This year, it may prove stubbornly low, giving the Fed room to further normalize interest rates. Thank you for listening. That was U.S. housing inflation, stubbornly high to stubbornly low. For future insights, please follow us on your favorite podcast platform. Macro Signposts highlights weekly takeaways from the data analysis conducted by our team of economists and other macro experts. For PIMCO's official views on the global economy, please visit PIMCO.com. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need, and it is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcast may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.